What if everything we thought we knew about the Federal Reserve's next move is wrong? It started as a subtle signal at an elite economic conference, but that ripple might soon become a tidal wave, one that could raise stock markets or crash them flood markets with liquidity or reveal just how fragile the economy really is. Powell has spoken. The money printers might be warming up again. But will this be the return of easy money or the start of something far more dangerous? Do you believe the Federal Reserve will cut rates in September? Yes or no? Drop your thoughts in the comments. Because what you're about to learn in this episode of Epoch Report just might flip your investment playbook upside down. We're diving into 3 critical insights: how to know if this rate cut is an opportunity or a massive trap, which sectors could thrive if the tide turns, and the trio of technical indicators professional investors watch like hawks during policy pivots. Stay with us until the end, because the clues buried in today's inflation numbers and Powell's language could reshape everything about your financial forecast. Now let's start at the top. Federal Reserve Chairman Jerome Powell just gave a headline-grabbing speech at the annual Jackson Hole Economic Symposium, and the markets are buzzing. In measured yet unmistakable tones, he signaled that the door is opening toward a potential rate cut this September. But don't assume it's straightforward. Powell emphasized just how uncertain the economic outlook remains. Shifting landscapes in U.S. taxation, trade setups, and immigration policy have complicated the Fed's balancing act, juggling its dual mandate of maximum employment and price stability. So yes, the idea of a rate cut is very much on the table. But the more important question now is, will it work? Or are we heading into a rate cut environment that does more harm than good? Let's be clear. On the surface, rate cuts sound like good news. They can be. Lower interest rates reduce borrowing costs for businesses. That's a huge plus, especially for sectors that rely heavily on innovation and scaling. Think tech, clean energy, biotech. They tend to react fast and favorably to cheaper capital. At the same time, when banks offer lower yields on savings, investors look elsewhere for better returns. That money often flows into the stock market, lifting indices in the short term. But here's the flip side. If a rate cut is issued because the economy is already in trouble, it's more like a doctor prescribing steroids to a critically ill patient. It's necessary, but also a signal of deeper issues. In such cases, these cuts accompany declining markets, rising unemployment, and recessionary pressures. It's a policy move made not from strength but desperation. So which rate cut are we likely facing? There are 2 types. First is a preemptive cut. It's proactive, akin to taking vitamins before you catch a cold to soften the landing as economic momentum cools but remains intact. The second is a recessionary cut response after the symptoms have worsened. At that point, it's less about prevention and more about trying to minimize damage during free fall. Right now, July's numbers show a 4.2% unemployment rate and 2.7% inflation, still above the Fed's 2% goal. Employment remains pretty solid, though price pressures haven't vanished. This supports the case for a preemptive move, not a panic response. But that doesn't guarantee the market will react with optimism. Let's break this down with cold, hard history. In early 2020, as COVID broke out, the Fed dropped rates to 0 and launched massive quantitative easing. The result? A historic bull run? NASDAQ soared from 6,600 to well over 16,600, or 140% leap. QQQ rocketed from $160 to $400, rising 150%. But rewind to 2008's financial crisis. Rates were slashed just as aggressively. The Dow tumbled from 14,000 to 6,500, or 50% plunge. What made the difference? 2020's crash came from an external shock. The underlying economy was healthy. Liquidity worked. 2008's crisis came from within major systemic flaws in the banking sector. Rate cuts couldn't repair broken fundamentals. Technically, this showed clearly. In 2020, volume expanded and market breadth improved. In 2008, liquidity dried up and most stocks remained in downtrends. How do we make sense of what this coming rate cut might mean? Here are 3 key indicators professionals track. Market breadth. A genuine bull turnaround is broad. If the Fed cuts and most stocks rally, that's healthy. But if only a handful of mega caps rise while the rest fall, that's a mirage. Trading volume. Every trend needs commitment. If volumes rise as markets move up, it's a true breakout. In 2020, volume exploded alongside rallies indicating trust in the shift. The VIX index, also known as the market sphere gauge, falling VIX after a cut signals confidence. If it rises instead, investors fear the cut won't be enough and risk appetite shrinks. As rates drop, capital rotates in fast. There are three areas that typically benefit the most. Real estate and REITs. Lower mortgage rates boost housing demand. Real estate ETFs and home builders tend to rally. In fact, one popular home building ETF rose 10% last month alone. Crypto and mining stocks. Bitcoin just broke the $120,000 barrier, with mining ETFs showing notable strength. For some, crypto acts as a hedge against fiat money dilution. Gold and precious metals. Lower rates reduce the opportunity cost of holding gold. Technical breakouts are already forming, and gold ETFs are seeing strong support even on pullbacks. If you're still watching, you're not here for surface-level takes. Make sure you're subscribed and turn on the bell. We drop deep insights that mainstream media misses, and they could matter to your financial future. Asterisk, asterisk. When volatility comes, disciplined execution matters. Here are two technical systems you can adopt. Price-volume dynamics. A healthy uptrend always includes growing volume. If you see prices rising while volume shrinks, that move may not last. Trendline breakouts. When a stock breaks long-term resistance with volume confirmation and candle reversal, that's often the start of a new trend. A case in point. Tesla in 2020. Caution isn't weakness, it's wisdom. Risk management is the foundation of survival. Set stop losses below key support levels or prior lows. Position sizing, phase in gradually. Don't go all in on signals that aren't strong. Monitor sentiment. When market breadth weakens and distribution days rise, it's time to reduce exposure. Protect profits. Don't chase every rally. Here's the concern. What if we're already entering stagflation? That's when prices keep rising, but growth flatlines or slows. We've seen this before and it's ugly. We're hearing stories from middle America prices quietly jumping. Kids' clothes at one major retailer rose from $6.98 to $10.98. That's over 50%. One viral comment, wasn't it supposed to be Make America Great Again? Instead, it's Make Prices Higher Again. Even leading economists are flashing warning signs the distortion is real. The International Monetary Fund just slashed U.S. growth projections. In 2025, GDP is expected to grow at only 1.6%. By 2026, possibly as low as 1.4%. Meanwhile, prices for essentials like food and clothing have surged again, up to 50%. The CPI may read 2.7%, but ask any household. Inflation feels much higher. CPI relies heavily on metrics like rent and transportation. Housing makes up 30 to 40% of CPI, but with the housing market stagnant, it underplays actual inflation pain. Food and beverage, just 13 to 15%. Gasoline, even lower now, with oil dipping to $59 per barrel. The result? Stats don't fully reflect the reality millions of families are experiencing. New trade flow data confirms U.S. demand is relocating. June exports from China to the U.S. dropped by $4.4 billion. But that slack was picked up by places like Vietnam, Indonesia, Taiwan, and Thailand, up $4.6 billion collectively. Vietnam's trade surplus with the U.S. has even overtaken China's for the first time. Taiwan's U.S. surplus hit $12.6 billion in June alone. We're not seeing full decoupling, but diversification is unmistakable. Meanwhile, trade policy shakiness adds another layer of risk. Donald Trump's poll numbers have slipped to new lows. His approaches to tariffs, tax policies, and trade deals face mounting doubt. In our analysis at Epoch Report, the clock is running out on these trade war strategies. Global pushback and supply chain rewiring make continuation unlikely. Let's recap what we know. A rate cut is looking likely perhaps as early as September. Right now, it's positioned as preemptive, not reactive. That supports a nuanced bullish case. If that holds, we could see rallies in key sectors like tech, crypto, gold, and real estate, especially commercial REITs. But do not ignore the shadow-forming stagflation. Inflation rising faster than growth is a lethal pairing. It erodes profits, shocks valuations, and makes monetary policy far less effective. The smart money is rotating. They're embracing diversification. 30% in defensive equity, 20% in hard assets like gold and commodities, to 20% positioned in emerging stores of value, like crypto, minus 30% in cash or short-term treasuries, and above all, they're adhering to the 3 pillars of risk control: stop losses, smart position sizes, and sentiment awareness. I want to hear what you think. Is the Fed funding a comeback, or are we heading into the stagflation trap? Yes or no? Drop your view below. I read every one. This brought you value. Don't just like. Subscribe and hit the bell, because timing matters, especially in markets like these. This is Epoch Report, and we'll see you next time.